Welcome back to Private Market Talks, a Proskauer podcast. I'm your host, Peter Antoshik. Today, my guest is Tracy Stuart, CEO of Corbin Capital Partners. Tracy joined Corbin in 2004, and over the past 20 years, she has transformed the firm. She has grown it from a few hundred million to over $9 billion of assets under management. Stunning growth for any firm. As CEO, Tracy has evolved Corbin into an alternative funds manager. It now focuses on hedge funds and credit investing, including spearheading a robust sustainability strategy. During our conversation, Tracy discusses Corbin's strategy, as well as its keys to success. She provides insights into where she sees opportunities for growth, as well as market headwinds. Finally, she shares her thoughts on diversity and provides some advice for young professionals starting out in the industry. So as with all our episodes, you can get a full transcript of this episode and other helpful information at privatemarkettalks.com. And if you enjoyed this episode, drop us a note. We'd love to hear from you. And now, my conversation with Tracy Stuart, CEO of Corbin Capital Partners. Tracy, welcome to Private Market Talks.
Thank you. So good to be here. I appreciate it.
So as I mentioned in the introduction, when you joined Corbin Capital, it was just a few $100 million. And over the last 20 years, it has grown to be over $9 billion. Walk us through how Corbin has evolved over the past 20 years.
We've evolved a lot. We've had to survive, honestly. But when I first got into this part of the industry, hedge funds, so early 2000s, and it was a very different time. Hedge funds were treated with kid gloves at that time by investors. And I came from a background of broader asset management and thought it was such a strange dynamic that, the clients weren't the center of the universe. Hedge funds were. So we kind of looked at that and looked at what was happening in the space. And at that time, hedge funds were a big part of the hedge fund landscape. There's a better way to do it than what was largely being done in the market at that time. At that time, fund of funds were over-diversified. Clients had too many of them, and clients just weren't getting what they wanted out of the asset class. So we looked at it. We had a chance to start something a little different because we were later in the game than many of our competitors. So we decided to build a better mousetrap, which meant building concentrated portfolios, investing with new small managers. And we took sort of an R&D approach to our research. And then we can get into this, but then after the crash of 2008, it really led to some other interesting ways of working with our partners and investing. So that was early days. Then after the crash, the landscape really cleared. The fund of funds business as it existed over the next, decade, largely went away. There's very few of us left that were called fund of funds back in the day. And frankly, it was because the space did not deliver for clients. Clients wanted better results, lower fees, stronger performance, improved transparency, lots of things. So there was a real clearing out in the space and a shift. Fortunately, we were part of that shift. So we were able to take advantage of the client moves. And what the clients were doing is consolidating, working with fewer partners, and those that stayed in the space consolidated with a handful of us. So we benefited from what was happening in the hedge fund landscape.
And what was the shift specifically in terms of either how the fund invested or was managed?
Well, the shift for clients was to work with fewer.
Got it.
And to have portfolios that were more focused on returns than they had been. In the past, they had just been far too diversified. The shift for us, the reason we benefited from what was happening is because really, we kind of built a different mousetrap in the first place, but then after the crash, we were able to really broaden our toolkit of investment options, and particularly in credit, because credit was so dislocated during that time. We looked around and said, wow, we could really make some money here. And fortunately for us, we had some assets to put to work, which at that time was very valuable for our manager partners. We had invested with some of the top credit hedge funds in the world. And we went to the one with whom we had the most conviction and said, will you do this for us? We wanted a slice of their portfolio. We wanted to pay half the fees. We did not want it to be in a fund. We wanted to have full transparency into pricing. So they actually agreed, and we got a separate account, very targeted portfolio at low fees, and that really was the beginning of our opportunistic credit business, which has flown through our core strategies, but it's also given us a chance to build out a credit business.
And so, what does Corbin look like today?
Well, so we're a little over $9 billion, as you mentioned. We have multi-strat hedge fund clients, both commingled. A large part of that business is in custom portfolios that have grown with us. We have a liquid credit business in commingled form, and we have a private credit business of various forms and flavors that has both been a return enhancer in our multi-strat portfolios as well as a growth driver for us. We see, just as you see in the market with private credit, there's a lot of money flowing into the space. So we are growing in that space as well.
So one of the terms you used was that your research focused approach. And I think you alluded to the fact that that is a differentiator. Can you explain what you mean by that?
Yeah, so I mentioned after the crash, starting to work with managers a little bit differently. Basically, in the credit space, asking them to unbundle what they were doing so we could just choose a portion of what we thought was sort of either their strongest capabilities or something that we really wanted in portfolios. And importantly, at lower fees with more transparency, more liquidity, et cetera. So that started it. But it really, what we did back then it was in 2008, is just an example of the way we invest, kind of our mindset. You mentioned an R&D approach, which means if the investment team finds an interesting new opportunity, they can pursue it in a very small way as we learn about it and determine whether we can really add value in that particular space. If not, we'll stop. If so, we'll press on it. And if it's really working, we'll resource it. So we've done that in a number of areas. First, with our opportunistic credit investing, we did the same with CLOs in 2011. CLOs after the crash, all the acronyms were bad words. They were scary. So really, they were not broadly used as they are today. And we started investing in the space. Clients were questioning it. But, we now have a pretty robust allocation to CLOs and tremendous expertise in that space. So really across nearly all sectors, but particularly in private credit, we try to be a little bit ahead of the curve. We are in very active, high-touch assets that are intensive. They can be complicated, but worth it in terms of the differentiated return streams we can get.
So obviously, as you mentioned, private credit has exploded, and it's an area that we've covered a lot on this podcast. What area of private credit do you specifically focus on? Because there has been a segmentation within the industry.
Yeah, the industry's grown tremendously.
Yeah.
So many firms have piled in. The big private equity firms have piled in, all sorts of new players in the space over the past decade. We really invest across the spectrum and to varying degrees, depending on where the investment team is finding what they believe to be the best opportunities. So today, we do sort of corporate lending, middle market corporate lending. We invest in asset backs, which I think you've covered pretty well in your program. We invest in secondaries, which is new-ish and growing because of the growth in private credit. We invest in litigation finance, which is more niche-y. You're starting to see more interest in that space, but we've been at it for 7 or 8 years and have a very interesting sort of investment program in LitFin.
So I'd love to peel that back a little bit. First, in terms of the private credit, I'm curious in terms of the secondaries. That has been a huge area of growth, particularly this past year.
Yeah.
And of course, there's been growth both on the LP and GP side of secondaries. I'm curious as to do you focus on a particular area? And of course, credit secondaries in particular have started to to take off as well.
Right.
So I'm kind of curious as to what your particular focus is.
Yeah. So it sort of syncs with our focus across credit. But, as you mentioned, private equity secondaries have been sort of longstanding, right? Allocation
Yeah.
and client portfolio. So there's familiarity there. So it doesn't feel so weird in the credit space. Then as private credit is growing.
Certainly on the LP, private equity, LP side, the GP is a
Yes.
little bit newer, yeah.
Yeah. Thank you. So we actually did our first private credit secondary in 2004, but those deals were few and far between. But we think the private credit secondary market is kind of where the private equity secondary market was maybe a decade ago. So for us, we focus, as with other areas of credit, on less crowded parts of non-sponsor asset-backed lending, as opposed to the larger end, sponsor-backed direct lending space. That's just, there's so many large firms competing for those deals, and in that space, that's just not where we operate. For sort of most of what we do, we're below that. We're in the sort of lower middle market space across asset types, and we're looking for parts of the asset space that are just less competitive, right? We're looking for better returns with better terms and preferably not too much risk. We tend to work with smaller to mid-sized managers, fundless sponsors, and we've developed, because of our core business, an enormous network of partners, maybe 100 partners across all that we do, doing various things. So we have sourcing, but also for the managers, we're also a client in some cases. So they don't look at us as a competitor. So it's an interesting seat to be. And we have developed over the years very robust sort of infrastructure on the investment team in the sort of back middle office to support that work, because it really is very hands-on.
So given the depth and breadth of the number of partners that you're working with, what are you hearing from them in terms of activity, trends, in terms of what they're seeing, not only in terms of new deals, but also portfolio quality and performance?
Well, you'd have to break that down, right? Because we work with a lot of different types of groups, investing in very different spaces. So you'd have to break it down into which part of the market you're talking about. But if you want to focus on credit or private credit, right? Well, high level, I think everyone is pretty aware that valuations are pretty lofty, right? In credit, spreads are tight, high yield's pretty tight. There's not a lot of obvious places to look for real value, at least in our team's view. In the credit space, we're somewhat defensively, not entirely, but somewhat defensively positioned, even though, the headlines are all that, the fundamentals in place. Hardly anyone predicted the fact that markets and the economy would be fine after 2022 with the surprise rate hikes. Hardly anyone anticipated that, right? But things have been pretty steady Eddie since then. And we're now in a pretty normal rates environment. Rates at 4 to 5% are pretty typical. What we were experiencing after the crash was not typical. So for us, what does that mean? As with others in private credit, take advantage of floating rates, look past the headline levels of fundamentals being solid. Companies seem to be in decent shape. Default rates have been pretty benign. But if you look sort of underneath that, there's a lot of noise. The credit markets have changed a lot. So under the surface, the higher for longer environment is taking a toll on lower quality companies that are highly leveraged. And so we can see that noise. It's nothing terrible yet, but we see that. And you don't really read a lot about that. Some of our managers are talking about that. And also talking about the idea that the private credit markets really haven't been challenged since the big growth over the past decade and all the new players have come in. We haven't really had a recession, so there will be trouble. Just can't predict the timing.
And so what kind of questions are you asking your managers in terms of how they are preparing defensively?
Yeah, well, again, it depends on the space, but a huge focus of ours, both the manager perspective when we're investing in a fund or when we're investing in direct deals and co-investments, is just in credit. to really understand that upside downside. Unlike with equities where you have a lot of upside, with credit, there's no real upside, right? You have your yield. So you really have to focus on the downside. Losses are very painful. So you have to be very careful about that. And it's a different mindset. So we're always looking at that. And particularly now in this environment, I'd say, we've been, as I mentioned, just perhaps a little more defensively positioned. We try to keep the durations or the terms of our deals on the lower side, whereas some private credit deals or loans are maybe 5, 6, 7 years. We really try to shrink that to get to walls in the 2-year range. We just don't want to take a lot of duration risk. We just don't know what's happening out there, right, in the future.
I would also suspect that, given the sector of the market that you're in, your documentation is probably tighter, and therefore you're less susceptible to some of the gamesmanship that you read about in some of the larger capital market style credits.
It's a great point. So the credit markets generally have changed so much, right? So private credit, bank disintermediation, the banks have pulled back. The BSL market is huge with huge players. Then you have private credit going. Those two used to be two kind of distinct markets, and now they're kind of converging. You've got the higher end of the market that's very competitive, a lot of large firms competing for the same deal. So you have, lower rates, worse covenants. It's just crowded. But if you move down from the sort of high end of the market to the lower end of the market, particularly in private credit, you can negotiate bespoke terms. You can be more flexible for the borrowers, but you can get certainly better, on average, certainly better yields and much stronger covenants. So we just think it's perceived as riskier, and the companies probably are, but you can structure your terms in your favor because it's just a much less competitive space.
Since you're anticipating the potential for some headwinds, are you positioning yourself for distress opportunities?
Yeah, not really, because we just had a discussion about this in the investment meeting this morning. That's a very, very difficult space to do well in, the distress. And we haven't really had a distress market for quite some time. So
I can't remember the last one,
right?
By the way.
Yeah.
I used to do a lot of distressed debt, but that was, I don't know, 2 decades ago.
Right. So in 2020, during that COVID situation, some of the managers started, whatever they call them, extension funds or something, to take advantage of the opportunity that was coming, and then it never came, right?
Yes, the maturity wall.
The Fed bailed everyone out, fiscal policy, et cetera. So we haven't seen it, but what we do have, and we look for this with our partners when we're invested in funds and when we co-invest and we build the capability ourselves, is to have strong sort of asset management and workout, experience and skills on these deals, depending on the sector and whatnot that you're in. You really need to track these things very carefully and learn, as soon as something starts to turn, there's a lot goes in motion. So there's a lot to it, but we're not, we're paid to take risk. So we do take risk. We just try very hard to be smart about it, to shrink the duration and protect ourselves. And we've gotten better and better at that with experience on the covenants and the lawyering and the terms and all of that.
So you've mentioned private credit and the various areas that you're investing in. You've also mentioned litigation finance. Are there other areas that you're focused on?
I think we discussed in the past briefly the asset-backed space, but that's, I don't think that feels new to anyone. There might be variations on the theme that are newer, but that's been around. And across credit broadly, we think corporate spreads are very tight, not a lot of opportunity there, although we do invest. Structured credit can be more interesting. We have CLO book and RMBS. We've been pretty short on the CMBS. And in private credit, as I said, it's lower middle market lending, corporate, and otherwise. We invest across the spectrum. We think the juicier returns right now are in litigation finance and various flavors of co-investing. Secondaries can be very interesting because you can buy them at diversified portfolios at good discounts. And, just lending to the smaller companies that are still fairly underbanked. We have no shortage of ideas. We kind of have more coming at us than we have money to put to work.
One of the areas of focus that is sustainability and impact investing.
Right. Well, we had a multifamily office client come to us, I don't know, 5 or 6 years ago, and they have a big impact program, but on the private equity side. They asked us if we would create a hedge fund, sort of an impact ESG, winners portfolio for them. You can't use that language today in this environment, but we had been looking at the space for a while, trying to understand what it was and, what it meant from an investment perspective. So we were pretty well versed in the space. We hired a director of sustainability a few years ago. And so we did create a portfolio for that client. And what we found is most of the activity in that space, and no one is using ESG anymore, but in that space, the activity is in public markets in sort of long only screened funds, right? Sort of semi-passive funds. All the money in the impact space is in private equity and venture capital. So there was not a lot going on in the hedge fund space. So we have found a handful of managers that we think are strong in this space. But perhaps more interestingly, with our private credit toolkit, if you will, we started applying an impact lens on our private credit deals, a few years ago. And we found that a pretty big chunk of what we were doing really aligns with impact. So now we do a fair bit in private credit impact. I mean, anything from...
Can you give an example?
Yeah, exactly. So in litigation finance, we funded opioids litigation on behalf of individuals and hospitals and some others. That, that's still being worked out fully, but that is going to work out well for the individuals and the hospitals and those involved. We have invested in electrification of buses in Australia, affordable housing in New Zealand. We've invested in greening brownfields sort of plants and areas in the States to turn sort of, offtake from manufacturing use into biofuels. So there's actually a lot that you can do in lending that aligns with impact. It's new, it's coming, but we're seeing interest. So we think that's an emerging growth area as well.
How do you think the current environment will affect that on a go-forward basis?
I'll tell you, I don't have to think about it. So people started changing their language a couple years ago and, not saying ESG, but maybe saying sustainability. So superficial things to kind of shift to be a little bit more in sync with the current political environment. My view is for large firms, they kind of have to change their language and be careful because of their very vast constituents and perhaps exposure to the government. But for those of us who are committed to the space and frankly under the radar, you need to make sure you're, aligning with the legal environment. Our lawyers are all over this. But otherwise, what we're doing day to day isn't changing. The language might change, but those of us who know that having diversity of mindsets across lots of things in an organization adds value. There's no question, it's been datafied. We know that. We're not going to shift, off of that. Investing in areas that are both good investments for clients that produce solid returns and are in sync with good behavior, right, is both good from a risk perspective. You can promote the work we need to do for climate. You can promote, work in social justice. There's just a lot going on out there where the Venn diagram of good investments and sort of impact come together. And very few groups are doing this work in the way we are. We've built up, as you mentioned, a very robust capability in the space. And I'm not sure that in the States there will be huge demand short term, but I believe globally, especially among large family office groups, there is demand and it will continue. I don't think it's going anywhere.
So as you look out, you have, as you said, you're research driven and you have your team in the laboratories looking for that next opportunity, that niche opportunity that will drive alpha. What are you not in today that is on your radar that looks interesting?
If it really looked interesting to us, we'd already be in it in some way. So I can't think of anything the team has surfaced that we haven't explored. I mean, this isn't new, but we've invested years and years ago, but we're revisiting, the reinsurance market, right? Because a lot going on in that space. So sometimes what we find may have been a theme that we liked 10 years ago, but now we see value in it again, so we'll come back to it.
I'd like to pivot from investing to distribution, fundraising. Obviously, the mega trend right now in the industry is tapping into the private wealth market. I don't believe, correct me if I'm wrong, I don't believe that is your focus necessarily, since your focus is institutional clients and family offices. What you've seen migrate from the institutional fundraising to the private wealth channel.
Right. So I would bifurcate into that sort of retail, private wealth, and then large family offices, right? And so we're not in the retail space at all. We are in a couple of bank platforms. So we work with them as institutions, but their clients are high net worth. And I believe, that the trend there is absolutely for the asset managers to provide alternatives products to these clients, and clients are really looking for those sorts of products. So the kind of retailization of alternatives is happening, but we're really not part of that. We see that as a field primarily for the larger firms, right? We have to pick our spots. But what we're finding to be super interesting, which has not been a focus historically, is the multifamily office space, I guess, globally. And we've just been engaging over the past year, and that is an enormous, if you call it a market or many markets. And what we're seeing there is super sophisticated families and family office groups, and specifically looking for alternatives and often niche alternatives, and they're looking for advice. So we've come across a number of what you would call gatekeepers, almost like the consultants in the institutional space, that are working to source good either funds or often co-investments for these clients. And that group is one that has been particularly interested in our litigation finance work, along with other things. We get interest in the co-investment deals that we do. So we're looking at, how and if we might be able to offer that to clients. We're working on that.
And what kind of questions are you getting from the family offices?
Well, not that different from the institutions, but just, wearing different hats and with a different lens, perhaps. They are looking for strong risk-adjusted returns. Sort of low teens without taking on too much. Some are in private equity. Well, most probably are. And, that space has been challenged. So they want a little more liquidity, but strong returns and interesting ideas. And I'd say that a lot of the questions we're getting are focused on the co-investment space. The large ones who group up, sort of can do club deals, they want to go in on direct deals. And whether or not they're sort of equipped internally to process that information effectively, not clear, but they like the idea of the results they can get from, particularly in the private credit space, co-investments.
So as you look out over the next 3 years, what trends, the impact of which you think might be undervalued by allocators and investors?
And by that, you mean macroeconomic trends or just anything?
I'm not saying macroeconomic trends, macro trends that it would impact how you think about your investing, your core investing strategies.
Right. There's a lot going on. Now, I've told you we're not prognosticators. We don't
No,
believe
no.
that anyone does that effectively. However, you do need to take the current, context into account when you're investing, particularly from a risk perspective. So many things. My view, this isn't necessarily shared by my team, but our team, the geopolitical, emphasized political environment right now, I think markets discount. I think they discount the risks, throughout the system globally and the noise in the system. Not sure exactly what you do about that, except maybe, create fairly defensive portfolios. Another trend in the hedge fund space is the pod shops are in such demand, and they've created a huge, I want to say vacuum, just enormous demand for talented individual portfolio managers. And there's a huge talent war going on there and crazy compensation. And I'm not sure what the implications of that are going forward, but that's something that's happening in this industry. Along with that, I think the long short equity kind of model is very challenged. If you look at the structure of the markets and how they've changed with so much money going into passive, so much money being managed by the shops and the pod shops, it seems there are structural changes in the market which might make it more difficult for the managers who are more focused on fundamentals and shorting on fundamentals. So that's something we're looking at. Traditionally have invested, with more fundamentally oriented long short managers or managers across the board. And that space has been challenged. I mean, money's been flowing out of that space, and it's just been harder, I think, for that group to make money in the same way as they used to. Some still do. It's just difficult. Along those lines, I've read and seen a little bit that portable alpha is making a comeback. So portable alpha was a thing before the crash, and then I think it blew up. Those strategies blew up and went away, but I'm being told that's back. So the credit, especially private credit markets, will be challenged and stressed at some point. And there's a lot of groups in the space now that have not been in there for a long time. So that's usually not a recipe for smooth sailing. Absolutely. And, people ask, I love it when I read something about the markets saying, oh, in these uncertain markets, there's no certainty in our business. Never was, never is.
Right.
If we could predict the next disaster, we wouldn't be here. So you don't know what's coming next, when it's coming, but you can get indications, based on valuations and what's happening in the world around you. And that's what we try to do without forecasting, right? We don't have any big forecasts.
And also, perhaps more importantly, is having the skill set to be able to manage through the volatility.
Having the skill set and honestly, the longevity and the working together as a team in these different market segments, because you learn so much. I mean, Craig and I were around during, further back than this, but the 2007 crash, the 2000, the tech bubble, 1987 crash, I hate to admit.
No, so was I.
You learn a lot. History rhymes, it doesn't repeat, but you do learn.
You've successfully steered Corbin over the last 20 years to where it is today. What have you learned along the way about leadership?
Well, I mean, I learned, fortunately, for me, a lot about leadership prior to joining Corbin. I started as an investment consultant with Wilshire, and there, when you're a consultant, you learn the client side. You learn to think and work for the client. So that's sort of the most important lesson you can learn in this industry. Then I started a business with John Casey, consulting to asset managers, some of the largest firms in the world. And we did strategic projects for them because of John's relationships that he had. So I got in to see the inner workings of some of the largest asset management firms in the world and leadership, good, bad, and ugly. It was fascinating and such a lucky seat to be in, for a young person. And then hired by Goldman to start an open architecture program. So learned about the inner workings of an asset management firm with, incredibly talented people. So all of that really brought me to Corbin and the skill set to understand the industry, the client, investments, and so importantly, leadership. When we started here, we put our heads together and said, who and what do we want to be? And we were so clear on the message of delivering for clients, or we shouldn't be here, of building this is such an overused statement, but strong and resilient, maybe, culture, so that we, created the environment, the resources, the infrastructure for people to do their best work, but not the noise, not the nonsense, not the turf wars, not all the stuff I saw at, other firms. And we work extremely, extremely hard on that. In fact, I did a little talk at our client conference a few months ago on culture. It's actually being studied now and datafied that strong cultures, they can connect to strong outcomes and sort of a connection to strong or stronger investment returns. So that's new work, but it's starting to be datafied. And in this industry, this isn't really something you heard much about 10 years ago. So just the fact that people are paying attention to culture is great.
What advice do you give young professionals today who are looking to navigate their way in this industry?
Well, I tell everyone, people coming out of college and when they're starting their careers, to get career counseling or coaching. It's something most of us do sort of mid-career, mid-life. But if you can do it early and learn how you're hardwired, that can really lead you to options that you're better or worse suited for, right? We're all wired very differently. And when we kind of profile, we have not a test, but something we have people do before we hire them. It's a modern version of a Myers-Briggs and really gets at how you're hardwired. And you will see the investment team members have very similar profiles. Salespeople have similar profiles, etc. So we're all hardwired differently. And those characteristics, will make you more or less effective in a particular job or environment. So long-winded answer on the first one. I recommend a book called Open Mindset, which I love. And I think you can, if you read it, look at people in your life and quickly identify who's open and who's closed mindset. And having an open mindset will take you a lot farther in life. Another thing I recommend, and we very much try to act on this at Corbin, is learn to receive and give constructive feedback. Within our organization, we have kind of continuous feedback loops. We don't wait till the end of the year to give you some bad news or good news. To have a really rigorous culture, you need to give people feedback. You need to be honest. You need to be authentic and have a good dialogue. And that's hard for people. Most people have very difficult time with any sort of confrontation. And, negative feedback can feel like confrontation. So that's something I urge people to learn to do early in life.
I have enjoyed this conversation, Tracy. I really appreciate the thoughts and insights you've given. And I want to thank you for joining us on Private Market Talks.
Either. Thank you. It's my pleasure. I really do appreciate your having me on.
And thank you, listeners, for listening to this episode of Private Market Talks.